Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcon, along with Dennis Dick. And we have Kenny Polcari on the line. He is Director of New York Stock Exchange Floor Operations for O'Neill Securities. Kenny, I hope you got a lot of rest over the weekend because you're going to have one busy day.
I did, as a matter of fact. I had a beautiful weekend down the Jersey Shore, but yes, it is going to be a busy day, and you can kind of see it as this story unfolds, around the world. You saw what happened over in Asia. I think those markets overreacted a tiny bit because European markets aren't nearly down or under the same pressure that the Asian markets appeared to be, and I think Europe is taking it more in stride. And over here in the States, we're just testing our 200-day moving average, which makes a little bit of sense that was kind of where it wanted to go to see how the institutional set was gonna vote on this deal, right? In terms of are they going to run away from it? Are they afraid of it? Do they think it's really going to change the landscape? So we're going to see as this all unfolds. It should be an exciting day because it's very fluid over there. Meetings going on, and Angela Merkel meeting in France, and what's the ECB doing, and European Commission. So all day long, it's going to be just speculation and chatter about are they in, are they out? What's it really mean? Are they going to the drachma? Are the banks going to open? Are the banks going to close? And so it's going to create, the drama.
And speaking of drama here, we've had a couple interesting Mondays here. Last Sunday, big sell-off in the S&Ps. We came roaring back. Today we got the sell-off. We're coming back not quite as much. I mean, the characteristic of this bull market has been to buy the dippers coming in. There's been some pretty big dips here. This is twice in 1 week. Does this kind of maybe change your longer-term view, not just on the market?
It really hasn't. I mean, listen, today's dip or last night's dip, when you look at it, the S&P's opened down almost 40 handles last night at 6 o'clock, but you got to credit that, first of all, to it's an automated environment. It's a less liquid environment, and so the moves tend to be more exaggerated, right? We then rallied back. We were hovering right at the 200-day. My sense is that today, tomorrow, could the market get weaker? Could we test lower? Sure, but if you're looking at the longer-term picture, I think large asset managers and even individual investors are going to turn around and look at this as almost a gift because I think once again it's overdone. I think we talk about the role that Greece plays in the whole of the European Union. We talk about what they add or don't add to the whole of the European Union, and it's a small piece. And so ultimately, if the Greeks want to make the decision that they made, well then good for them. They're entitled to do that. But then the ball's now in their court. The rest of Europe doesn't have to roll over and play dead just because the Greeks decide that they don't want to honor their commitments. And so I think that's what's going to provide the opportunity. Listen, don't forget, automated and electronic trading around the world has allowed markets to react instantaneously, which then most of the time results in an overreaction in markets, right? They either tend to overshoot on the downside or overshoot on the upside, and you have to give them time to kind of rebalance. I think that's what you're going to see here. My view has not changed. I think the U.S. economy is going to continue to chug along. I think maybe not at the speed we all want it to, but I think it's going to continue to chug along, and I think the second half of the year is going to be a better story than what the first half turned out to be.
Kenny, though, what about the other countries? I mean, yeah, Greece is not that big of a country, and their GDP, whatever, we make comparisons. But isn't what's rattling the markets, other countries that are holding their paper in the Europe, like
right.
Spain
so
and Brazil?
It's not only certainly the banks that are holding their paper, and you saw what happened there to those European banks that have some exposure, but then you have the countries that stand to lose, tons of money if, in fact, Greece completely defaults. But think about it. If Greece completely defaults, I find it hard to believe that they're going to completely default. Who would ever trade with them again? They would never have access to the public markets. It would be a long time before they had access to the public markets again. It would be a long time before anybody lent Greece any money again. And so therefore, they've got a lot to lose if they don't negotiate properly or if they don't come to the table. So yes, the concern is that if they do, all this money is going to be lost. But I don't necessarily think that's going to happen. I also don't think, and I'm not afraid of, they're talking about the contagion with Portugal, Spain, and Italy, and if they see what happens, they're going to be the next countries to do it. I don't think so. I think Spain and Portugal and Italy, again, are making headway. They've made those adjustments 5 or 6 years ago. They're working through it. They'd rather stay than not. They don't have that same Greek mentality, and so therefore I'm not concerned about that as well, right? I think it may be tough here for, the next couple of weeks as we work through the Greek situation, but the Greeks have done this they've made this vote themselves. They've spoken. I hear it. You have to respect it for what it is. But that doesn't mean the rest of the world rolls over and plays dead.
Kenny, what does this mean for interest rates here? Because obviously you have a little bit of concerns here overseas now, and we're seeing money starting to move into some of the more defensive issues. And I noticed that the utilities catching a bid early last week here. Do you think interest rate hike for September is off the board?
Well, I think it certainly comes into question because I think the last thing the Fed or this country wants to do is add more uncertainty to global markets and certainly the U.S. market. And if Europe continues to be in this state of flux, I think the last thing any central bank, as a matter of fact, last night I think you had a lot of the central bank heads come out and try to calm the markets down and don't anybody panic. And the central banks, will protect the system. And so therefore I think that speaks right to that point. I think it's still a possibility. I guess less of a possibility than it was 2 weeks ago. I still think we're going to get one hike, and I think it's going to be later in the year, more like November, December than September, right? Although I do think I think the consensus calls for 2 hikes, September and like December. I think after this situation or as this situation unfolds, it might cause the Fed to just step back for a minute and say this is just not the right time.
So would you be a buyer of bonds here right now, or would you be a buyer of the utility stocks?
I would be a buyer. See, listen, I'm an equity guy, right? I'm not so much a bond guy. I think the bond market's a little bit overdone. I would be much more a buyer of utilities or dividend-paying stocks, strong blue-chip Americana dividend-paying type stocks, utility names, because I think for me, that's a good place to play it, right?
What about oil? Because oil's really taken a haircut here in the last week. We're almost $60, and quietly it's not getting any of the headlines here because of grease, but we're losing another $2.34 here this morning, and crude is starting to look broken here again.
Right. Well, I think it is, but I actually think that this is an area where it's been churning. Right. We traded. Where did we trade? Down to the low 40s in midwinter. We rallied back. We stayed here in the mid 50s. We pushed a little bit higher to 60. It's backing off again, hit to the mid 50s. I actually think that oil's okay here. I don't think oil's going to break down. I just don't think it's going to break down because I think the global economy is in fact doing better, and so therefore I think it's going to continue to support the price of oil. But listen, if certainly weak oil is causing weakness in some of the energy names. That makes perfect sense. But I think once again, people are going to be surprised because I think once you get through this grease thing, then the focus is going to turn right back again on kind of the macro issues in terms of macro global growth issues. And then people are going to realize that, that global growth is in fact moving in the right direction. Again, maybe not as fast as everybody wants it to, but maybe that's our new normal. And that being the case, I think oil holds. I don't think oil's cracking again and going back to $42 a barrel. I just don't see it.
Kenny, I want to talk to you a little bit about what's been going on with merger mania. And Dennis and I are kind of from the old school where, when a company does acquisition, it's dilutive, they're spending cash. And a lot of these stocks, like CNC on Friday, I mean, we could just go through a lot of stocks here that have just had tremendous pops in the pre-market because they are doing an acquisition here and then giving it all back. I mean, what is it? Just the high-frequency trading world that's interpreting these deals? What's the reason for the strange trading action?
Well, listen, I think the whole merger story is a story in and of itself, right? Companies looking for acquisitions, looking to grow. They've got lots of cash on their book. They've made such drastic cuts to their expense side. They've accumulating this cash, and now investors and shareholders are pushing them to start to really grow their business. People want to see top-line growth. They want to see real growth now. They don't want to see, growth by cutting expenses anymore. We've done 7 years of that. It's about time that companies put this money to work, and so which has caused this merger mania that we've seen. Certainly some industries benefiting more than others based on regulatory issues and such, right? But one way or the other, I think you have to just play. You have to look at which companies are making the moves. Do they make economic sense? Or is it in fact the right move for the market? And that's what you're seeing. Ones that are well planned and well timed certainly are met with investors love it, right? They think the deals are great. They think that the mood is great. Actually, a strong M&A market is indicative of kind of a very forward-looking guidance in terms of what these companies think of what their future looks like and how they can then grow their businesses. I think it's all positive. Certainly, it's all positive in that sense. It can be negative because, like you know, mergers will create duplicity, and duplicity will create some loss of jobs. But listen, that's the world we're living in now, right? And so everybody's kind of working their way through it and getting used to it. But one or the other, I'm not. The ones that are not good, the mergers that are announced that investors are not excited about. You see the reaction immediately, right? They vote with their feet. But ones that they're excited about, they certainly vote with their money, and they put it to work.
Good point. What about the IPO market, Kenny? Are you following? And obviously, we've had Shake Shack back in March, and it took off from 40, running up to 95. Do you think some of these IPOs are going to get a little bit overdone? Do you think it's a potential bubble here?
I always think the IPO market can get overdone. I certainly think the social media IPO market is one that is a little bit more antsy than maybe a more traditional industry group. Certainly, you can see the difference in when IPOs come down. You can see the difference in some of the IPO names or some of the social media names, how they react versus more stable industry type names. So I think it's like anything. You have to be careful. You have to know what you're investing in. You have to, especially in those names, you've got to do your homework. Look, you've seen what happened in a name like Twitter. They came out with their earnings after 2 months ago or something. They've just killed the stock because it's difficult in social media names and in that industry group. It's really difficult for these companies to really forecast. And so I think the difficulty is, or the sense is, for people that are investing in those stocks, you can't necessarily sit there and wait for the company to give them guidance because it's very, very difficult to do it. You either like the story or you don't. You either buy into it or you don't. You understand the risk or you don't. And versus, a more traditional IPO that's in a different industry that's got real stats that you can compare it to and you can measure it against. It's difficult to measure all these different social media names, or whether it's Twitter, whether it's Facebook, whatever they are, against each other because the industry is still so new and they're all feeling away. Names like Shake Shack, listen, that was always amazing to me because they serve burgers, right? Burgers and ice cream shakes. It's great. But do I think it gets a little bit overdone? I think it does. But also, you have to look at the size of the IPO, right? If somebody bringing 7 million shares, that's not a big IPO. So therefore, you would tend to have more volatility in a stock like that. If somebody brings 100 million shares, that's much more liquid, much more highly capitalized, and so therefore, you're not going to see that type of reaction in a stock that's much more highly capitalized.
Kenny, before I let you go, speaking of food, I know you send out a recipe with all your morning notes. You sent out the Wiener Schnitzel this morning, quite aptly for what's going on in the market. But I want to know what did you cook for the 4th of July? I would have loved to see your 4th of July recipe.
Well, you should have. Last week I sent it out. I made short rib cheeseburgers, which is actually a great recipe. You actually make the beef short ribs the day before. You put them in the oven and you bake them, and then you let them cool. You shred them, and then you take the shredded short beef meat, mix it in with the ground chuck, make your burgers, season it however you want, throw them on the grill, add whatever cheese you like. To use a brioche bun that maybe you've buttered a little bit, salt, lettuce, onions, tomatoes. It's great. Coleslaw on the side, you can't beat it.
Oh man, you're making me hungry.
It's in my note it's in my note from last week. If you go search my Twitter account, you'll see it. I think I did it on Tuesday or Wednesday last week.
All right, Kenny Polcari, Director of New York Stock Exchange Floor Operations for O'Neill Securities, giving us a great look at the market. Kenny, thanks for coming on this busy day. We'll speak to you again soon.
You're very welcome. Bye-bye.
Thanks, Kenny.